And it looks like we are still in quite uncertain times.
I think that the market certainly on the domestic front is challenged because you've had a tremendous run on equities, but it's not without lots of volatility and abnormal levels of volatility coming back into the market. Sort of peaks to troughs compressing in terms of the time it takes to get from a peak to a trough, and yet low interest rates. So kind of the danger to the consumer, to the man in the street and the saver, is that they are sort of hearing at dinner tables that the market's done so well. And as we are a bunch of lemmings, as individual investors, they start sort of capitulating and saying, well, we've been scared of the market because of the crash 2 years ago. It's now time to get back in, only perhaps ready for another correction. And if you look at the market right now, it's done remarkably well. We all know about the immense flows of overseas hot cash coming this way into capital market assets and equities. And if that turns around for any reason, there can be a severe correction, and only to be dealt to the poor individual who hung in there in cash. But with the latest cut in rates, and I think that there's going to be more to follow, that you have a second whammy, which is very difficult.
Do you think if you're not already invested on the JSE that it's too late to get in there and join in the momentum? Because it looks like a new base has been set. So previously when we had pullbacks, we were going down to the 28,000s, the 27,000s. Now we're really holding above that 30,000 level. Is it too late to join the party?
If you're betting the farm, in other words, you're a mature investor with a large amount of money, I would absolutely advise against going flat out into markets. There's always the old adage of cost averaging or getting in there on a tranche basis over time. Leaving funds in cash in the long term does not make sense because unless you have an enormous amount of money way beyond your income requirements, you're regressing simply because cash after tax doesn't beat inflation very easily or for any sustained period of time. So equities or growth assets like property make a lot of sense in that instance. The timing of accessing those markets does remain an important criteria. So over 30 years, maybe it won't, but over the shorter 5-10 year periods, which doesn't sound that short in the context of investing, but in those periods, when you get in, will make a defined difference to the outcome after that 5 and 10 year period.
And of course, you mentioned property there, and we had a press release through from the Property Loan Stock Association this morning just showing how strong the returns have been in property this year. So you're looking at close to 30% returns in the property market. So also looking a little bit toppy there.
Stephen, that's been a very interesting market because it's been much more resilient than the ordinary share, the JSE, in the ordinary industrials and financials and mining shares. It's a combination of a very nice level of income, although it's taxable, in the form of debentures out of those stocks. And the second area is capital appreciation. And property likes low interest rates. So the cap rates, the rates at which they value the underlying properties, benefit from the dropping of interest rates. They act like bonds in terms of their pricing models. So if you combine the capital appreciation over the last year, 2-3 years, with the sustained returns, it's been very good. One of the issues that does confront that sector is that because interest rates are very low, you're probably going to get people that are developers with deep pockets and large reserves saying, well, if I can only earn 3.5% after tax on my cash, perhaps I should put it in bricks and mortar with the belief that inflation will come back. That creates stock, that creates possibly a bubble in terms of supply and puts the shoe on the foot of the tenant rather than the person owning the building in terms of forward-looking leases. Inflation's also an issue there, where if inflation drops, you'd expect the rate at which rentals are adjusted upwards in the next reset of a lease to be at a lower than the previous 8s and 9s. Probably be in the sort of, there'll be pressure from both sides, and that get compounded by supply issues.
So what would you suggest then to investors looking at the property sector at this stage?
If they're able to sit tight, it is a growth asset, but with growth comes risk. Is that the price of the underlying units, the shares or the units in a unit trust in that sector will be volatile. They are equities after all, or they are market related. The income stream probably will be at a premium to dividends forever and a day, but they're taxable. So those considerations are important for the investor to consider. They always will, however, form a very important part of the growth, the part of the portfolio allocated towards growth assets, in our opinion.
Of course, you talked about the flood of money that has come into South Africa and boosted our bond prices, boosted our equity prices so far this year. How about yields on overseas investments? Given where the rand is at the moment, is this an opportunity for investors to be taking a look further afield?
Yeah, I think that the traditional markets that we have supported as South Africans, most of our key international assets like gold, oil, are priced in dollars. So people have looked towards the US. They've also looked from probably familial histories and 4, 5, 6, 7 generations ago, coming from the European and UK environment, at the sterling and obviously the euro more lately, and previously Deutsche Mark, etc. So if you look at those currencies, there's very little on the table as far as yield is concerned, because they're lending money at at historically low levels to try and stimulate those economies. So you're not getting much of a bang for buck in market, in deposit type returns. If, however, you look at Australia, they have had a firming of interest rates. It's also an interesting one for in our view, because they're offering a decent return on funds. And they are in a resource-oriented economy, but a non-South African one. So you're getting a decent interest rate with a non-South African flavour, which means you're diversifying. We do think that there's interest, that's interesting. The other thing that one can look at are the corporate and bank bonds that are an issue in the more developed markets, Europe, UK, and the US, where
perhaps not Irish bank bonds, though.
No, perhaps not. But you can get Standard Bank paper and some of the top corporates, Anglos and so forth, in a European and UK issue, and those yields are very attractive. They're not that easy to access, but if you have a relationship with a stockbroker that has an international arm or reach, those can form part of a portfolio and are trading at 5s and 7s, and even some of them higher than those yields.